After a buoyant 2-year in the housing market, business predicts a slowdown in 2023 with rising interest rates and increased cost of living expected to drive the cost of home ownership higher. We're not quite in a crash yet, as we saw in the U.S. during the recession back in 2008. But signs are there that although the total value of property sales continues to increase, new homeowners are facing a double whammy of a series of those interest rates increases and surging food and fuel prices, pushing the cost of home ownership even higher. And for more on this, I'm now joined by Mfundo Mabaso, who is FNB's Secure Lending Head. Thank you so much, Mfundo, for your time and struggling through connecting with us today.
Thank you very much for having us, Thomas.
Mfundo, let's start here. Now, the SARB will hold its MPC meeting tomorrow, with many analysts already expecting another increase. How has the series of interest rate hikes driven the cost of home ownership up, including loan repayments?
Yeah, so if you look at the repayment for customers who would have started off when the interest rate was relatively low, with the series of hikes that we've seen in the repo rate and that flows into the prime lending rate, it has meant that customers' repayments have gone up as a consequence of their interest rates associated with their home loans having gone up. So that has put quite a bit of a squeeze on customers' surplus and disposable income.
Now, Mfundo, aside from the interest rates, South Africans also face higher inflation, and load shedding is also an increasing cost. How much extra finances do we now need to actually cover the cost of owning a home? Perhaps give us an idea from, your low-cost home in the range of about 500,000 to your more expensive homes.
Yeah, so with all the pressures on, particularly on the low end of the markets, the more there is a pressure on income and disposable income, customers will find it a little bit more difficult to actually qualify for a home loan, which then means we might actually need these customers to put down a deposit, which is an additional cost to the home ownership journey for customers. Now, this will be more exorbitant for customers in the low end of the market, but the higher end customer is also not excluded from this. Over and above that, Togozo, you would imagine that there is the cost associated with actually owning a home over and above your repayment and your deposit. So if you look at registering a bond in South Africa, you still need to go and pay a registering bond, a registering attorney, as well as a transferring attorney, which is an additional cost for customers, which they'll need to also account for. There's also the unseen cost of owning a home, which is the moving costs, registering your rates and rates account with the municipality. If you're in a complex, you also have levies that you have to take into account. Never mind the fact that you might need insurance as well, whether it is life insurance covering the cost, covering the bond itself should anything happen to you, or the property should any unforeseen circumstances happen to the property. So there are these costs that customers would need to be aware of and account for as they go into the home ownership journey.
Now, Mfundo, once they've gotten into that home ownership journey, many South Africans who are under financial pressure often turn to withdrawing money from their bond to meet whatever emergency expenses that they may need to cover. What are some of the advantages but also disadvantages of doing so?
Look, once you're in a mortgage arrangement and you paid it down and you do need to advance against it, this might actually increase your repayment. So if you were paying 10,000 Rand, you might see that now you're going to have to pay the additional amount, which might actually put a squeeze on your disposable income. But if you look at the advantages of taking money out of your bond as opposed to other forms of lending, a bond or a home loan remains one of the cheapest ways of taking out debt. At lending rate close to prime, that actually does remain one of the cheaper ways of extending credit. So customers can benefit from there, especially if they don't treat it as a mortgage repayment and pay it off over a shorter period of time. They benefit from a lower rate, but also the buffer of a longer term, which then puts a little bit of a buffer for customers.
Mfundo, that's where we're going to have to leave it this afternoon. Thank you so much for your time. And, of course, that was Mfundo Mabaso, who's F&B segment growth head of home finance. Stephen, it's back to you.